Friends, if your portfolio is 100% in Indian equities, you might be missing some key opportunities. And global diversification could change your risk and reward game drastically. If you think about this, sometimes the US market leads, sometimes Japan, sometimes Southeast Asia, or the Europe market. The leadership every year rotates. And this can clearly be visible in the returns these markets have generated in the last 1 year comparable to the Indian market. When your investments are only domestic, you may be fully exposed to the local risk like currency depreciation, political issues, economic slowdown, and so on. If you're spreading a part of your equity abroad, it gives you a great cushion, and it is a proven that investing internationally can reduce volatility in the portfolio and hedge against the currency risk. Now, the question is, how much should we actually invest globally? Here is a practical rule. If you keep about 70 to 75% of your equity exposure in India, where one is updated about government policy actions, growth potential of the sector, you're familiar with tax incentives and capital gain structures. The remaining 25-30% allocate globally, maybe US, Japan, emerging Asia, or developed Europe, so that you benefit when these markets outperforms. Currency can hurt you if the rupee falls and your foreign investments becomes more expensive. But if you properly balance it, the global exposure can actually act as a hedge against the currency depreciation. Very importantly, the global diversification helps you to invest into the stocks or sectors or technologies that may not be available locally in the Indian market. Ideally, one should not aim at beating every market, rather aim to smooth returns, reduce risk, and capture the growth, no matter wherever the part of the world it is happening. And remember, your financial journey deserves the right guidance. Follow me to keep learning, growing, and investing smarter.